Hello and welcome back to the Dukascopy TV studio. I'm Natalie MacDonald and joining me now is François Savary, CIO of REYL Bank, to discuss the international equities market. François, thank you very much for coming in.
You're welcome.
Now let's start with trends. What trends are we currently seeing in the international equity markets?
Clearly we have an upward trend. Clearly there is an acceleration of this upward trend since November last year, mostly because of liquidity injection by the major central banks. And we believe that what happened in Japan with a change of course in monetary policy and the choice by the Bank of Japan to significantly increase its quantitative easing policy is adding to this acceleration phenomenon on equity market. The only region where you can see a divergence is maybe the emerging market, which are more difficulties progressing, mostly because there is good prospect of economic growth in the US and most investors are looking for the US first.
Now, touching on the relationship between equities and other asset classes, we're seeing an increasing divergence between equity prices and commodities prices. Can you talk us through some of the reasons perhaps behind that? And also, from an investor's point of view, should we be seeing it as a positive or a negative marker for global economic sentiment?
Okay, I would say that it's a negative. To answer the second part of your question, it's a negative to my point of view, because in a sense it's not logical that on the one side the commodity market are going down or are not progressing anymore, telling us that growth is not going to be so strong, and on the other side you have equity market pushing higher, meaning there that people are expecting that growth is going to accelerate. But then you need to accommodate, and you need a little bit to look at this relationship a bit differently. One of the main reasons why you had such a run on commodities for many years was the issue of liquidity. Liquidity was pushing the price of gold, the price of agriculture, of metal, and etc. higher. It was not only completely fundamental. So the fact that currently you have a divergence emerging is maybe because people are thinking that the liquidity is concentrating on the equity market, and maybe it's not that negative that there is this divergence. So to tell you the truth, I believe that this is a negative. This is the reason why we believe that people need to be aware of this divergence and take notice of it. But for some people, this is a natural development linked to the fact that people are getting rid of the idea that the liquidity is going to push higher and higher and help the commodity sphere to progress.
As we've sort of touched upon slightly, this divergence does really highlight just how high equities are pushing at the moment. Is this something that we should be concerned about?
Yes, you need to be careful about that. You need to be aware of what are your expectations for the economic activity in the coming 12 to 18 months if you really want to consider investing in equities. I believe that liquidity can push the market higher, but there is a moment where there is a moment of reckoning, which will be the economic activity. Liquidity cannot drive equity price higher and higher forever. You need to have EPS growth, you need to have GDP growth if you really want to consider that it is fair and nice to purchase equities. So yes, you need to be aware of this divergence and take that into account when you decide how you invest your money.
I guess the most important question of all really is now the time to invest in equities? What is REYL's positioning on this at present?
Currently, we are reducing risk of our equity allocation. Beginning of the year, we were still increasing our equity allocation. We were slightly overweight in equities. Currently, we are slightly underweight, and we have decided in the last few days to reduce even further our equity allocation because we consider that the market went too far too fast and that it is a time to take some profit. It doesn't mean that we foresee a huge correction on the market and that we would advise people to sell all their equity exposure, but we do believe that short term there is room for some profit taking and wait for a consolidation, maybe something between 6 to 8% move on the downside on the major indices to reinvest again your money.
How long, therefore, do you see this uptrend continuing?
Very difficult to say. It depends on the scenario that you have in your mind. If you are somebody who believes that we are just in a liquidity frenzy, I would not chase the market higher. I think that we are at the top of the market, if you believe that. Personally, I do believe that we have growth coming back worldwide and that 2014 should be a better year for economic activity worldwide. So there is ability for the market to push higher in the course of the next 12 to 18 months. So we will have consolidation in the short run to our point of view, but then the ability of the market to push higher is going to continue. Don't forget, that you are living in a very strange world in which people have purchased bonds like crazy. We do not see bonds as a significant, interesting investment for the coming years. It's very difficult to justify to stay in cash when you have zero interest rates on your cash. So equities is going to remain maybe an attractive investment asset for investors around the world in the coming years.
François, thank you very much for coming, and we appreciate your comments.
My pleasure.
That's all we've got time for right now, but we'll be back shortly with more exclusive interviews for you, so don't go away.